Okay, let's start. This is the last finale of the whole global seminar. Of course, people say the last is the best. So absolutely, right? so excellent. And this is extremely important subject, not only insurance sector, but the global economy. As you know, that climate change have a material risk created in our community, particularly in the future. And not only insurance sector, but financial sector, regulatory community takes action. And one important action that we have taken is to enhance disclosure. So we make it totally clear and open what does it mean. So our Financial Stability Board, where IAIS is a member, so together with other financial sector leaders, regulatory leaders, we create this disclosure recommendation. And today's group discuss this issue. And excellent panelist again, and the leader of this panelist moderator is Nick Robbins, co-director of United Nations leading this project. And we attended, IAIS attended also so-called Sustainable Insurance Forum. That was kickoff meeting hosted by Dave Jones. Excellent meeting. Thank you. In December last year, and we had excellent meeting as a regulators community led by United Nations and also Dave Jones. So anyway, this is a key issue and excellent panel here, and we can learn a lot of what insurance regulatory committee and of course industry's view too, what we should take action and how we learn and move ahead. So thank you for this introduction.
Thank you very much, Yoshi. Thank you very much for that introduction. And thank you for allowing us actually to host the second meeting of the Sustainable Insurance Forum alongside your meeting. It was great to have you at the inaugural meeting with Dave Jones in San Francisco. And we're really grateful for your cooperation, Yoshi, and also others in the Secretariat. So we have a panel looking at sustainable insurance. This has been discussed, I think, in many times in this audience. It's rising up the agenda within the sector. Climate change has become really a focal point for this. And I think it's now becoming a serious material issue for the sector, and supervisors are starting to respond. So this is the agenda for this afternoon, and we want to focus our attention on disclosure, as Yoshi said. This week, in fact, on the 29th of June, yesterday, was the release of the recommendations of the FSB task force on financial disclosures on climate change. And we're lucky to have Andreas Spiegel, one of the members. And so this will be almost a first view on what do those disclosures mean, both for the sector, but also for you in the official sector, in the supervisory sector. What does this mean for you and your oversight function? So I'm going to give a brief introduction, then we'll introduce the panelists, and we'll keep it tight. There are not many sustainability jokes, I'm afraid, so we'll have to keep our eyes open for those. But the one thing I do know is that time is the one non-renewable resource. So we're going to keep very close to time, and it's 10 minutes for each of the presentations. So, where are we? What are we talking about in terms of sustainable insurance? As we've heard from Yoshi already, these issues, sustainability factors, environmental factors, but also social factors, are increasingly material, both for risks and opportunities for firms, and supervisors are responding. The forum, which Yoshi mentioned, the Sustainable Insurance Forum, was brought together from conversations with a number of supervisors, two of them on the panel, Natalie from Brazil and Dave Jones from California, really as a place for supervisors to exchange experience and maybe take sort of common perspectives on things. Climate risk and disclosure is the point we're discussing today. This week we've had the FSB disclosure recommendations, and I think one of the things that we're already finding is supervisors have a role in terms of promoting high quality disclosure, in terms of the long-standing function of market discipline. So, sustainable insurance, a strategic approach to ensure that activities in the value chain of insurance are conducted in a responsible, forward-looking way. identifying, assessing, managing, and monitoring risks and opportunities, environmental, social, and governance. And it's relevant for supervisors in terms of the safety and soundness of the transition. Two real approaches we've been involved in. One, in terms of the market, UNEP, United Nations Environment Programme, has been working with insurance companies for over 20 years, and we are the host for a voluntary initiative called the Principles for Sustainable Insurance, a set of principles which about 20% of the market have signed up to in terms of integrating environmental factors into core business strategies. So that's on the market voluntary side. And then the project that I co-direct on the inquiry, we've been looking really what do these factors mean for the overall rules and architecture of the financial system, in this case particularly insurance. So, as I mentioned, we have action, things are happening. It's early days. In France, insurance companies, along with other investors, are now required to disclose how they're managing the transition to a low-carbon economy. The UK conducted under the Prudential Regulatory Authority an assessment of climate change risks for the sector. The Netherlands, DNB, the Dutch Central Bank, have done a wide view of carbon asset exposures for the economy and are starting to think about supervisory implications. In California, we'll hear more from Commissioner Jones, some mandatory requirements for insurance companies in terms of potential risks around fossil fuel enterprises. Morocco, interestingly, have embarked on a sustainable insurance roadmap as part of an overall national roadmap for sustainable finance. And Brazil, again, we'll hear more from Natalie Hurtado in terms of surveying the sector to look at actually what is happening in terms of insurance firms' action. Obviously, a very important first step before you look at what supervisors can do. So supervisors are starting to take action. The forum, as we've heard, launched last December. We have got Dave Jones in the middle. We've got many of the people that are here in this room there. Really just a network, an informal network to enable sharing of experience and common responses to common challenges. A number of supervisors attended, including the IAIS, Brazil, California, France, Ghana, Jamaica, Morocco, Netherlands, and Singapore. Tomorrow we have our second meeting. We're delighted to have this back-to-back with the IAIS, and we have 18 supervisors attending. My colleague, Jeremy McDaniels, is in the room. He's there. And if any of you would like to attend, the invitation is open. I believe it's going to be in the Balmoral room. And we'll be discussing particularly climate risk first thing in the morning. A number of tracks of work, one on disclosure, which is today's agenda, access, insurance roadmaps, climate risk, disaster risk reduction, and then crucially, capacity building. What do normal, routine insurance supervisors need to enable them to manage these issues? They're never going to be environmental specialists, but what is the capacity they need to enable them to do their job? So, briefly, on the Financial Stability Board, we'll hear a lot more from Andreas Spiegel, looking at a market-led voluntary approach to disclosure of material climate change issues, a framework that is very standard in financial markets, looking at what does this mean for governance, for strategy, for risk management, and then sector-by-sector specific metrics and targets. And Andreas will go in much more detail on that. This process has been going on since the end of December 2015. It's an industry-led task force convened by the FSB, and they've had a number of opportunities for consultation. The consultation draft came out this February, and one of the first things, in fact, that the Sustainable Insurance Forum did was to say, well, what does this mean for us as in our function as being insurance supervisors? So a response was developed, and I think some interesting themes came out of that. What can supervisors do in terms of promoting awareness of the recommendations among regulated firms? How can they perhaps also help build capacity in firms? And also sharing some tools which are quite complicated potentially around scenario modeling and metrics. To what extent should supervisors think about including some of the results of these climate disclosures into their routine supervisory functions? How to integrate climate disclosure into a broader focus on sustainability? And finally, to what extent should supervisors endorse the recommendations either on a voluntary basis or on a mandatory basis. Clearly, very different mandates, very different objectives in different countries. So that's the sort of initial response, and I'm sure many of you in the room will be thinking, well, what should you as supervisors be doing in response to this very high quality, very sober document about climate disclosure and the relevance for insurance? So, just briefly in terms of the forum, as I said, our next meeting, our second meeting is tomorrow here in Windsor. It's a particular focus on climate risks. We'll also be thinking about a response to the final recommendations of the FSB. We'll be launching later this month a stock take of practice around the world in terms of sustainable insurance by supervisors. Our third meeting will be in Kuala Lumpur at the end of the year alongside the IAIS. And again, thank you to the Secretariat for being so accommodating, and also to the Kuala Lumpur, so the Malaysian authorities. And finally, just to emphasize, the focus of the forum is very much on practical outputs, best practice guidance, but also this area of capacity building for supervisors. So with that context setting, I will sit down and briefly introduce the panel. So, on my immediate right, we have Natalie Haanwinckel Hurtado from SUSEP, the Superintendence of Private Insurance in Brazil. Next to Natalie, Dave Jones, who I've already mentioned, the Commissioner of Insurance from California. We then have, to Dave's right, Andreas Spiegel, Head of Group Sustainability Risk from Swiss Re, and also, as I mentioned, a member of the FSV Task Force. And finally, Cynthia McHale, who's a Director of Insurance at Series, a non-profit based in Boston. So, Natalie, maybe if you could go first for your 10 minutes, please. Thank you.
Okay, good afternoon. I would like to thank IAIS for the opportunity to be here, presenting Brazilians' efforts and also a developing country experience on such an important subject. So this presentation will be on how Brazilian Insurance Supervisory Authority and its supervised market are dealing with, especially the environmental dimension of the sustainable insurance issue. For issue, you can understand risks and opportunities. To make it clear and concise, I will use the 5W and 2H approach. First W, what? So what are we talking about? ESG risks and environmental, social, and governance risks are highly correlated, especially when we are dealing with inclusive insurance markets. The social and governance aspects have been well understood by supervisors and industry in general. On the other hand, the environmental assessments of environmental issues and their eventual impacts on insurance are still at an early stage. Those who don't believe in anthropogenic global warming are going against 97% of the international scientific community with an opinion on climate change. The effects of the global warming are already evident and can be seen, for instance, in this picture I am showing you. And that shows the Great Barrier Reef in Australia. These bleached corals used to be very colorful just a few months ago. So, what should the insurance industry be concerned about? I believe in participating more effectively in the search for solutions to deal with these global risks, which can potentially affect countries and mainly their more vulnerable communities, but also may affect insurance investment results and liabilities best estimates. In Brazil, SUSEP led a survey last November in a joint effort with the Brazilian Insurance Association to understand the level of environmental initiatives of the Brazilian market. It was made on a voluntary basis and 75% of the supervised companies answered the questionnaire, which corresponds around 90% of the Brazilian insurance premiums. 8% of the companies responded that environmental issues are very important to their business strategy. However, when asked how many the following issues, I'm not sure if you can read, but it's there: climate change, change for consumers' expectations, change on consumers' expectations, natural disaster, and food security, and so water scarcity, animal well-being. So when we asked to them which of these issues were being of their worrying to cause any kind of impact on their business, the scores were very low. Even for climate change, it was less than 50%. So what they are saying was not in connection in what they were really doing. So the second W is why. Why is it important for the insurance industry to be concerned about finding a solution? Worldwide, natural catastrophe losses, many of them with roots on human actions, are growing fast since the 90s, as you can see on the Swiss Re graphic. Part of these losses are insured, and of course, insurance losses are growing as well. They are the black line. Nonetheless, the part of the losses that is not insured is much bigger and growing even faster, which means that there is a huge protection gap. My point is, if the insurance industry is not complying with its role of building resilience and providing proper coverage, some other player may do so. In November 2015, Brazil suffered its worst environmental catastrophe in history, the Marianas disaster. Marianas disaster was caused by the tailings dam disruption of an iron ore mining company nearby one of Brazil's most important river basins that runs across 2 states. The toxic mud that invaded the river killed 19 people, destroyed family crops, exterminated many aquatic and surrounding species that fed indigenous tribes and coastal communities, reaching the Atlantic Ocean in 15 days. Many kinds of local economic activities were jeopardized or completely eliminated. Insurance coverage responded for only 8.3%, less than 90% of all losses in the disaster. The mining company did not have coverage for environmental liability risks. The total losses are around $90 billion, but this will be a long litigation in courts that can make the company, insurers, and reinsurers pay much more than they are willing to now. 90% of the 1,000 biggest Brazilian companies do not buy environmental risks due to 1. Inefficient supervisory and enforcement systems. 2. Lack of a regulatory framework. 3. Cultural issues which involve governance aspects. And 4. Lack of proper insurance products. So the third W, when. When should the insurance industry be concerned to make part of the solution for ESG risks? I believe action is past due. Insurance companies are losing in 2 fronts when deciding to do nothing. They are not occupying their natural space as builders of economic resilience and risk mitigation. And they are missing out on investing in assets without assessing relevant associated risks, which is very highlighted in FSB Task Force recommendation. As Nick said in his introduction, UNEP has the Principles for Sustainable Insurance, the PSI. Brazil has the biggest number of companies as signatories. However, despite this high engagement, the recent survey showed Brazilian companies are still much more focused on internal actions than in the business core activities when considering environmental issues. Being the asset risk management, the area that needs more education. Fourth, W, who? Who will be responsible for the solution? Who is responsible? Because the problem is already done in evidence. New generations of consumers are much more aware and involved in sustainable issues, demanding more transparent positions of the products and services they consume and own as shareholders, as was very debated in the panel before this one. Also, insurance companies, they are the ones that really can make things happen. They need to reinvent services and solutions with focus on consumers, improving their role as risk carriers, risk transfers, and investors. Insurance supervisors as well. They are behavior drivers for insurance transition in many jurisdictions like mine. For this, to my point of view, it is needed to incorporate ESG approach on risk-based supervision, both on prudential and conduct of business risks. They are even more correlated under this perspective because the impacts of risks are amplified. 5W, where? Where should the solution be developed? Broadly speaking, in the whole insurance value chain. Design of products and services, underwriting, selling, distribution channels, asset and liability risk management, payment process. In different degrees and parts of the chain, of this value chain, but I believe also for all kinds of coverage, life, property, and liability. For our consumers, the insured ones and the not insured yet. The point is that the concept of sustainability in insurance is not just another risky topic or a new cover to be addressed, but a perspective that should be in the underlying business. Second, first H, how? How can the solution be implemented? The intensive use of digital technology is fundamental for improving methods of risk analysis, underwriting, risk management, and claims payment, as said before in the earlier former panel. Besides improving the process and lowering the costs, technology can help data and information gathering and identifying where the public is and what they need. Also, multilateral cooperation needs to dialogue with other sectors of economy or even other governmental levels and countries. In terms of Brazil, we have the problem of Amazon forest, which is divided by many countries in Latin America, Brazil, Bolivia, Venezuela, Colombia. So Brazil is the 7th country in terms of greenhouse gases emission because of Amazon forest deforestation. So it's a solution that must be pursued by all these countries together. Not only Brazil is enough to respond to this. Build codes and land use, natural disaster, water crisis. The joint solution should be based on disclosure of data and information. Second, H, how much? Last but not least, how much must be spent? At first, we believe that it's not a question of more capital requirement. we think of stimulating companies to the pursuing of capacity building and innovation. The way to achieve this target must begin with requirements of transparency in financial filings, to give conscience to insurers about their role and importance before environmental issues. SUSEP's survey brought out the knowledge that most of PSI signatories and others that demonstrate understanding and commitment to environmental issues don't really incorporate them to their daily core business activities. It is much more a kind of reputational image initiative. So, one of the proposals is requiring disclosure framework of the financial impacts caused or probable to be caused by climate change in the public financial filings on the basis of the FSB Task Force recommendation. Other proposal we have to incentivize a better behavior of the companies before the environmental issues is to create a seal of quality for best initiatives based on the recommendation, because, as you said, they have many layers, to be publicized at SUSEP's homepage. This kind of experience was already put in practice in our financial education policy in Brazil. Okay, I finished. Thank you. Thank you for your attention.
There we go. Isn't that perfect? I hadn't seen the slides. Thank you so much. Bravo. Commissioner, please. Thank you, Natalie.
Thank you very much, and I want to begin by thanking our host, the Bank of England and the IAIS, for inviting me and the rest of the panelists to participate today. This is a picture of me when I was much younger, before I started thinking about climate change and climate risk, and now I'm a lot older and unhappier because I think a lot about climate change and climate risk, but in any event, I want to thank Natalie also for co-chairing the first meeting of the Sustainable Insurance Forum, and again, I reiterate the invitation that Nick made to any regulator who hasn't already agreed to join us tomorrow. If you haven't, please consider doing so, because we would really welcome your participation in what I think is an important set of discussions around these issues. I thought what I would do is first begin with a commercial about California. Just in case you forget where we are, we're uniquely positioned to secede from the United States geographically, but we are the largest insurance market in the United States, where insurers write about $289 billion a year in premiums. We're the 6th largest insurance market in the world. We have 1,300 admitted insurance companies that have collectively $7.5 trillion in admitted assets, and I have 1,400 wonderful professionals that assist me in regulating that market. I thought what I would do is, building on Natalie's very excellent framework and overview presentation, is drill down a little bit on some of the things that we've been doing in the United States, specifically the NAIC Climate Risk Disclosure Survey, a California Department of Insurance Climate Risk Carbon Initiative that's unique to California. Third, talk a little bit about some of the tools that are available to insurers as well as regulators in the United States to address or report or disclose climate risk, and then do a light touch on the task force, although I know Andreas is a task force member and he's going to do a deeper dive on that. So first, I think it's important to note that the National Association of Insurance Commissioners in 2009 adopted a climate risk disclosure survey that has 8 questions that seek qualitative information from insurers with regard to what they're doing to address climate change and climate risk in their business operations, their underwriting, and their reserving. The survey is mandatory in the sense that we require, those of us administering the survey require insurers to answer the questions. We do it on an annual basis. The survey is directed at insurers that have over $100 million in direct written premiums. There are 5 states in the United States that are currently involved in administering the survey. It's California, New York, Minnesota, the state of Washington, Connecticut, and New Mexico. And collectively, we're reaching 1,000 insurers that represent 77% of the U.S. insurance market by premium value. Then we take all of the answers that the insurers provide us and we put them on our website, the California Department of Insurance website. It's an online database. You can do searches by a product line, by company name, across categories of questions. And we think it important to make that information available to consumers and investors and other insurers and other regulators. So all that information is there. And there are organizations like Ceres, who you're going to hear from in a little bit, that have taken that information from the NAIC Climate Risk Disclosure Survey and actually used it to do various analyses and report cards on how insurers in the United States are responding to climate risk. So based on doing these surveys for the last 7 years, my department concluded that one area that we ought to uniquely focus on is what insurers are doing or not doing in the area of their assets and asset management as it relates to climate risk. And I think it's important just to briefly note some of the things that have been going on contemporaneously in the last number of years. I mean, first, we've seen a dramatic decline in the price per kilowatt hour for renewable energy, making it more competitive in many markets vis-a-vis fossil fuels. We've seen a whole host of adoption of legal and regulatory measures by local governments, state and provincial governments, national governments, international bodies that are designed to try to restrict the burning of carbon. These take the form of carbon taxes, cap and trade systems, the enactment of or expansion of clean air regulations that place more demanding requirements with regard to emissions from the burning of carbon, policies that require utilities to rely less on carbon for their electricity generation. For example, in California, by state law, we've set for ourselves and our utilities a requirement that by the year 2030, 50% of the electricity generated by utilities in California has to come from renewable sources. And there's a bill pending in our state Senate now that would move that to 100% of the electricity has to come from renewable sources by 2050. And that bill has every likelihood of passing and being signed by our governor, Jerry Brown. So a host of different things occurring both in markets and in the policy space, and of course COP21, international agreement of most nations of the world to make commitments to reduce their reliance on carbon and their emissions. I think coal requires a particular note, a mention of the fossil fuels. One is the Dow Jones U.S. Coal Index has dropped 92.9% in value from 2011 to 2017. We've seen 35 U.S. coal companies declare bankruptcy. We've seen 69 North American oil and gas producers file bankruptcy. We've seen California's major pension systems, CalSTRS and CalPERS, lose a combined $5.1 billion in their oil, gas, and coal investments in 2014, 2015. We've seen 4 major U.S. banks announce over the last year or so that they're no longer going to invest in or lend into major coal infrastructure projects. We've seen Deutsche Bank, which is one of the major international banks that historically was a major lender, investor in coal infrastructure, announce as well that they were no longer going to invest in coal. And we've seen major global insurers like AXA, Allianz, and Aegon announce that they're divesting or not making new investments in thermal coal. So we have, at the California Department of Insurance, observed all of these things that are occurring in the world outside of the insurance space, either in markets or through policy or regulation. And we've taken note of them. And much as the chair of the Financial Stability Board, the governor of the Bank of England, in September of 2015, in his speech at Lloyd's, pointed to one of the major risks being transition risk, we've concluded that there is a significant risk associated with the potential transition away from carbon, the potential that carbon assets on the books of insurers will become stranded assets, and as a prudential regulator concerned about making sure insurance companies are investing in ways that retain value, don't lose value, so they have money to pay claims, that is worrisome to us. So we then launched our Climate Risk Carbon Initiative in early 2016. It has essentially 2 facets. I'm talking fast because I'm worried about getting the hook from Nick. So the first facet deals with thermal coal, and I did a deeper dive a moment ago with regard to what's happening with thermal coal, but we have concluded that thermal coal either is or has a great potential of being a stranded asset, so we've asked the 1,300 admitted insurers that are licensed to sell insurance in California to consider divesting from thermal coal. And we've asked them to refrain from making future thermal coal investments. We have administered a survey to all 1,300 asking what their response is to our request. We've taken their results and made those public as well. That's the first facet of the Climate Risk Carbon Initiative. Second, more broadly, we've required additional disclosures with regard to insurance companies' investments in oil, gas, and coal, and utilities that derive more than 50% of the electricity from oil, gas, and coal. That second portion of the initiative is directed at admitted insurers with more than $100 million of U.S. premiums. The first portion is directed at all 1,300 admitted insurers in California. Again, the second facet, the fossil fuel holdings disclosure, we require them to disclose, and we make that information available publicly as well. So what are the top line results? We collected this data over the course of last year. We announced these results in 2017. It's all available on our website. Of the companies that we surveyed, they have about $528 billion in fossil fuel-related investments. Only about $10.5 billion invested in thermal coal enterprises. Since the date of the request, they have divested $4 billion in thermal coal and fossil fuel investments and have committed to divesting an additional $944 million of thermal coal investments. In addition, 303 of the companies reported already having analyzed the risk of carbon investments in their investment portfolio, so that's good news. Another 81 of the companies committed to do so in the next 12 months. 670 companies reporting having divested some or all of their coal holdings or having no coal holdings to divest, and 325 companies acknowledged they would refrain from making future investments in thermal coal. So those are some of the top-line results. You can go to our very user-friendly data portal. You know, I violated the one rule of public service, which is never do IT. But we were able to pull this off. And so all this data is available in a very user-friendly way. I won't go into great detail, but we've got all sorts of helpful pie charts and graphs and so forth that allow you to do deeper dives with regard to overall results of the survey, but also to do specific dives into specific companies with regard to their investments in coal, fossil fuel, and what share of their overall assets carbon makes up. And so mindful of the time, I just want to move to the third topic, which is the other initiatives and tools that are available to regulators in the U.S. Obviously, we're taking the information in California that we gleaned through the Climate Risk Carbon Initiative, and we're using it as we do our routine financial examinations. There's also an instrument called the NAIC Enterprise Risk Management Report that insurance companies are required to file, and that's another tool or vehicle by which companies can identify and report on climate risk. And of course, there's the Onerous Solvency Assessment tool, which I know many of your jurisdictions have adopted as well. That also provides a vehicle or avenue for us as regulators, but also for companies to address and report risks in this regard. Andreas is going to do a deeper dive on the Task Force on Climate-Related Financial Disclosures. My department commented on that report favorably. We're very keenly interested in and very excited about the conclusions and recommendations that report has reached. We do think that the task force, the FSB, and the G20 should take concrete steps towards making sure that the recommendations are incorporated in regulatory regimes of financial regulators. So just finally, a conclusion. The California Department of Insurance believes that climate change does pose a potential financial risk to insurers' investments in oil, gas, and coal. We are adopting financial surveillance tools to begin to query insurers about this. We believe that the widespread adoption of the TCFD recommendations would help provide greater clarity, greater uniformity, greater consistency across all market segments of our economies, but provide better information to insurers and better information to the banks and better information to insurance regulators and bank regulators with regard to these risks. So we're very, very hopeful in that regard. And finally, I'd say that one of the things we're going to talk about tomorrow at the Sustainable Insurance Forum as IAIS members is what do we think as regulators ought to be done with these task force regulations. So sorry about the speed, but I want to try to beat Nick giving me the hook. I should have closed with an unhappy picture of myself, but you've been a kind audience. Thank you very much.
Thank you very much. You had 1 minute. So Andreas,
thanks.
I think you would give us two quick presentations, one on Swiss Re and then one on the task force. Is that right?
Yeah, exactly. I'm wearing two hats today, basically one as a member of the task force and one as a representative for Swiss Re Reinsurance Company. So thank you for giving me the opportunity to speak to you. I think some 3 years ago, I wouldn't have thought that I would ever speak to insurance supervisors, but thanks to North American leaders, I have to say, to Commissioner Jones and Mark Carney and Mike Bloomberg. I think things have changed a little bit, and so great honor to be here. Let me start with how this discussion got started. I think climate change was described scientifically as a market failure by Lord Stern some years ago, 2009. Mark Carney built on that and described in a famous speech back in 2015 the associated risks of climate change as potentially a risk factor that could threaten the stability of the financial system. And the reason for that, in his opinion, was basically the fact that these risks and opportunities and these transition issues are not disclosed properly. So market participants, lenders, investors, insurers are not aware of what's coming, are not aware when they invest in companies, and this needed to be corrected. Fundamentally behind that, there is the idea basically that by unleashing the market forces and providing more transparency, that climate change can be corrected, or that the transition towards a low carbon economy can be accelerated with this. So the aim to promote more informed investment, credit and insurance underwriting decisions and understand better the hidden carbon-related risks. For this purpose, we developed in a process which took 1.5 years, these disclosure recommendations. So that's the heart piece of the 3 reports that have been published yesterday. The recommendations are structured basically in 4 different areas. Governance is basically the request to companies, stock-listed companies, to disclose how they decide on climate-related issues and risks, so to ensure that board attention is given, and to describe also the executive management contribution to how companies deal with these kind of risks. Then the second part is a strategy section where companies are asked to disclose their view on the actual and potential impacts of climate-related risks and opportunities. They are asked to define those impacts in a short, medium and long-term time frame. And the really innovative or the new element that is currently not considered in any disclosure requirements, financial disclosure requirements, is strategy C, which is the request to describe the resilience of the organization's strategy, taking into consideration different climate scenarios, including a 2 degrees or lower scenario. So basically, companies should test how they align their strategy, their long-term strategy, to the Paris Agreement, essentially. The risk management section is then basically intended to describe how a company identifies these risks, how they model it, how they deal with it. So to disclose the sophistication of how they assess these issues. And then we have the 4th section, which is all about targets and metrics. So companies are asked to disclose certain metrics, for instance, carbon footprint, and disclose also targets, goals, that they associate to material risks and how they want to manage these risks going forward. So the sustainability wish, to always structure disclosures in terms of targets and metrics and actions, I think is well recognized in these recommendations. For particular importance for the insurance industry is the fact that in the metrics sections, insurance companies will be asked to disclose their annual expected losses from weather-related perils. That's one specific metric that normally gets reported only to regulators and has not been made public so far. That's a first, element, small element that will be disclosed, and we are asked to disclose that. A second element that applies to insurance is related to the investment side. So we will be asked to disclose the carbon footprint of our investments, so carbon intensity of our investments, and calculate that. The report is structured in a main section about the disclosure recommendations and in supplemental guidance for specific sectors. So on the financial industry side, we distinguish between banks, insurance companies, asset managers, and asset owners. Again, for insurance companies, the supplemental guidance for insurance companies applies, but also the one for asset managers. So we act as asset owners, and for asset owners, as I should say, which applies to our investment side. And the non-financial groups have been structured in 4 subsectors that received supplemental guidance. And you can read that in the appendix of the report that has been published yesterday. So the most important element is the scenario analysis. In the consultation phase, we've received a lot of feedback about that, and companies highlighted the difficulties related to scenario analysis. And what it really boiled down in discussion was that many thought this would be a request to disclose a forecast, basically, hard numbers, how the world will develop in 30 years' time. That's clearly not the case. So it's about scenarios, testing assumptions, testing possible futures against the business case, and determine basically whether current activities, economic activities, or long-term strategies would be threatened by that. So that's important to know. It's not about forecasts. It's also from that perspective not capital relevant or liquidity relevant as such. In terms of the project, so the report has been released yesterday, and now we're entering an implementation phase and monitoring phase. So the task force will continue to exist for another year. We will help basically do the outreach, explain all the details of what companies are asked for, and then review what gets published in the next reporting phase, and then summarize that, and with that also try to support a consolidation of approaches and metrics, and come up probably with another summary report in a year's time after second quarter 2018. So that's quickly an introduction from my side, and now I changed the hat and the slide deck, I hope. Yeah, okay. Technology, digital analytics, here we go. Yeah. I'm reusing my slide, our slide, again, just to make the point, about the systemic nature of climate change. What you see happening is basically the protection gap, the difference between societal losses and insured losses is increasing. The main reasons for that is currently not climate change, it's social and economic development. It's the fact that we build infrastructure at the coast and near flood zones and rivers. So that's the main driver at the moment. But nevertheless, when you add climate change to that, that's an additional aggravating factor. That will mean basically that the burden for society, but also the burden for the economy will most probably increase. On the more positive side for the insurance sector, it also means there's an opportunity to develop new products and help adapt to the unavoidable consequences of climate change. There are also opportunities associated to renewable energy. Think of wind energy, where the insurance industry is really asked to develop new products and help transfer novel risks, and with that also accelerate the journey towards a low carbon economy. So it's both a risk for society, but also an opportunity. What's really asked from the insurance industry is to continue to model the risks, the weather-related perils. I just take that screenshot from our internal model, how we look at tropical cyclone risks. So we have a probabilistic model which is based on historical data. So these are the spaghetti tracks of tropical cyclones over the last 100 years. Statistically, we can enrich that, and with that we can cover probabilistically basically a time span of 10,000 years. And we update and enrich this methodology with latest scientific evidence, and this hopefully will always allow us to predict and price the risks for the next year. Also important to say that all our policies that we have, weather-related policies, are renewed on a yearly basis. So the big duty for insurance industry is to maintain models, be up to speed on the latest scientific evidence, and include that into your modeling. Stress testing, we do a lot of scenario stress testing already when it comes to the major weather-related perils. So for us as a reinsurer, Atlantic hurricanes are one of the big weather-related losses. So we do that on a yearly basis. And this is basically what's important for solvency-related aspects, but it's almost unrelated to climate change. So it's really for next year. It's short term, but I think that's another element. Small print, but the key message is basically on our investment side, we develop our understanding about the long-term implications and the transition and how that will affect certain industries, and we incorporate that into our investments. So we try to identify stranded asset risk potentials. We also divested from coal for that reason. We implement ESG benchmarks that will allow us to improve the sustainability performance, or basically to cut out the downside of the possible climate transition out of our investment portfolios. We also actively invest in green bonds, so we grow a green bond portfolio, and the goal is there to build it up to $1 billion investments. So that's also ongoing. I think that's the most important part, where we can incorporate our strategic thinking into better investments. And that's, again, an opportunity that is triggered also through the task force recommendations. And we have a lot of internal discussions that got triggered also because of the new disclosure requirements. I stop here. I think that's, in a nutshell, from the reinsurance side of things.
Thanks, Andreas. Thanks for linking that at top level of the FSB and then what you're doing internally. We're in good time. Cynthia, could you give the perspective on actually what's happening more on the investor side? Thank you.
Yeah. Thank you. It's an honor and a pleasure to be here. I just have to say, our intrepid moderator, Nick, as we were getting up onto the stage here, said, "Cynthia, you're on the far right." And I said, "You know, Nick, no one's ever said that to me before." So, something new. But that's enough for politics. I can't help it. I'm from the US. We have a lot going on. All right, well, let's jump in here. We're going to do a little bit of a deep dive on one aspect of the work that came out of the FSB TCFD, which is related to 2-degree scenario analysis. This, while scenario analysis isn't new, this aspect of it is quite cutting edge. So we thought we'd give it a whirl and see what we could come up with. We collaborated with 2-Degree Investing Initiative. They're really the experts. They have the methodology, and we partnered with them to try and think this through. So let me see here. First, just 2 seconds on Ceres for you that may not be familiar with this organization that I work for. We are a Boston-based independent nonprofit that promotes sustainability leadership in the private sector. We oversee Ceres Investor Network on climate risk that has today about 130 institutional investors with about 17 trillion in assets under management. We also oversee Ceres Company Network, which includes Fortune 500 companies and many other major corporations that are, again, committed to improving their overall sustainable business practices. Ceres and investors and the companies we work with have pushed for improved climate risk disclosure for well over a decade now. Our focus remains on improving disclosure of material climate risks and opportunities. We encourage the use of the Sustainable Accounting Standards Board, or SASB, standards for financial filings. I'm not sure, again, if you're familiar with SASB. They're a terrific organization. Again, they're a US nonprofit building sustainability accounting standards that help public corporations, that is, disclose material decision useful information in their existing financial filings, such as the 10K and the F20 with the SEC. They have just launched, by the way, an independent assessment of the economic impact and value for all public corporations in the US to disclose their sustainable business practices. So, quick question. How have companies and investors supported the FSB TCFD? Well, they're quite supportive, in fact. Over 300 investors with 18 trillion in assets under management wrote to G7 and G20 organizations supporting the Paris Agreement and the work of the FSB TCFD. Additionally, 27 CEOs with over almost 5 trillion in assets under management have publicly urged the G20 acceptance of the FSB TCFD recommendations. I will say this slide is already a little bit out of date. I saw with the rollout of the final recommendations yesterday, there was a letter with over 100 corporations that have signed on endorsing this. And I'll read quickly one statement from that letter. It says, "We believe that climate change will have significant impacts across many sectors, and that we as business leaders have an important role to play in ensuring transparency around climate-related risks and opportunities. These disclosures are an important step forward in enabling market forces to drive efficient allocation of capital and support a smooth transition to a low-carbon economy." Importantly, 6 insurers also signed on to that: Aegon, AXA, Allianz, Aviva, ING, and Swiss Re. So let's dive in for a little bit now to 2-degree scenario analysis. This is the exercise that we undertook with 2DII, 2-degree investing initiative. It is a forward-looking exercise, and that makes, I think, all the difference here. We're in an environment where there is sort of building risk, and the challenge, and it's been commented on by Mark Carney, is this idea of the tragedy of the horizons. I think scenario analysis is a way to bring future risk to the present and to use that understanding to influence companies' business strategies and tactics. This is sort of a conceptual model here. It starts on the left there with the 3 different categories of climate-related risks. Those are physical risks, transition risks, and legal risk. This was described by the Bank of England in a report they put out a couple of years ago, and they've also updated it in their Q2 2017 Bulletin Response to Climate Change. So you can read a lot more about these 3 different categories, but essentially, physical risks are those that arise from weather and climate-related events such as droughts, floods, storms, and sea level rise. Transition risks, which is what I'll be focusing on, are related to transition to a low-carbon economy, changes in climate policy, technologies, energy technologies in particular, and market sentiment can prompt a reassessment of the value of a large range of assets in a large range of industries. And the next 15 years are expected to be critical. And then last but not least, legal risks. I think this is a very complex area. It really relates to a broad range of climate change liability issues and are particularly relevant to insurers as liability is transferred through a range of products such as D&O, E&O, and product liability. So for this work that we did, we were focusing on transition risk, which primarily comes through the investment portfolios that insurance companies hold, not exclusively, but primarily, and then downflowing into the asset side of their balance sheets. So where are the exposures here? What investments are most at risk? For the analysis that we did, we used the work of Moody's. They released a heat map in 2016 of sectors at risk from environmental or climate risk and trends. And I think this gives us a good proxy for high-level exposure assessment. We looked at the top 2 risk levels. Those are elevated risk in the next 3 to 5 years. So that's immediate elevated. And those are deemed by Moody's to have higher credit risk today and going forward, and then emerging elevated. And you can see some of the industries that fall within those 2 categories. For the overall, I just want to sort of reiterate, and I think reflects well on the work of Commissioner Jones, that coal infrastructure, and unregulated power utilities were deemed by Moody's to have the most material credit impacts and require rating adjustments today. So I'm going to show you just a few of our findings. We don't have time to get into a lot of detail, but we will be putting the full report, and there'll be an audio, sort of a YouTube video, so it talks people through this. So what did we find? We looked at 35 large US insurance groups. We used their Schedule D fixed income holdings. You can see there's a range, a broad range of percentages of holdings in these elevated risk categories, ranging from 3% to 28% of fixed income assets. That reflects about $360 billion overall. And this, by the way, is using 2015 end-of-year data, financial data. One of the other things we looked at had to do with the maturity of those holdings. So long-term risk maturity matters. Holdings in higher risk sectors can be mitigated with shorter maturity holding periods. However, as we see here on this matrix, I couldn't not put in a matrix, being a former consultant. 6 of the 35 insurance groups have a high fraction of holdings in risky sectors and a high fraction of long maturity bonds. What we did after this, and I won't show you right now, but what we did is we took the holdings today of these 35 insurance groups and then mapped them forward going in time compared to what we refer to as a 2-degree aligned portfolio. And that's based on the commitment of 174 nations that signed the Paris Agreement, limiting global warming to well below 2 degrees scenario. We use the International Energy Agency transition forecasts to map, again, these portfolios against what that energy transition line looks like. And again, you can see the results by company. All right. Is this the last 2 pages? Okay, so summary, 2-degree scenario analysis or transition risks only of these 35 large insurance groups show that many insurers are overexposed relative to 2 degrees Celsius in various technologies facing transition risk, and insurers are also underexposed to low carbon clean energy opportunities in a 2 degrees Celsius world. We saw that there is a lot of value in the process. Even an approximate answer is a useful exercise. This is still evolving. The methodologies to do 2-degree scenario analysis are complex and they're not set yet. You can do it sort of on a qualitative top-down basis, a thought exercise, or do a bottoms-up sort of qualitative assessment, which is what we tried to do. Bottom line, the FSB task force recommendation signals to companies to start the journey, and the open source tools already exist. As we know, European regulators are already using 2-degree scenarios to compare regulated entities and examine potential systemic risks. So with that, I will wrap up and turn it back over to you, Nick.
Thank you very much, Cynthia. Thank you. Now it's over to you in the room. I think the 4 things I've heard from Natalie, essentially sustainability issues are not a separate category of risk. It needs to be incorporated into core prudential market conduct operations. From you, Dave, that actually climate change is actually a market risk. And actually there's now some experience in terms of supervisors thinking about how to monitor this and how to encourage disclosure. Andreas, you set out the framework in terms of governance and strategy and risk and metrics and some of the particular things the insurance companies are going to be dealing with. And I think what was interesting from Cynthia is actually some of the tools that have been talked about, the scenario tools, are actually ready and available. They're not perfect yet, but there's nothing stopping us actually starting to assess these risks. And something you mentioned a couple of times, which I think is very relevant to this room, is that the credit rating agencies are now starting to assess these risks and incorporate it into their assessment of creditworthiness, both on the sovereign side and on the corporate side. And that's particularly relevant for the insurance sector. So over to you. I'm happy to take questions from the room to the audience. So please indicate your thoughts, comments, questions. Thank you. So.
We've completely convinced you.
So one of the things...
I'm happy to break the ice now.
Break the ice. It's actually quite warm in here, but the ice is going fast.
On this side, at least.
That's very good. Maybe introduce yourself.
Sorry, Round Douglas from Willis Towers Watson. Oh, I've got to stand up, have I? Sorry, I arrived late. Oh, God. I'm much better sitting down. I just want to perhaps draw the 2 points. Natalie's focus on the protection gap and the role of insurers, obviously, to help close that gap, and the fact that actually the gap's growing in some respects. And then the wider discussion about disclosure of risk and bringing these two things together, because in fact they're obviously two sides of the same coin. If more people understand their risk or are forced to disclose it, there will be hopefully a drive to close the gap. And one of the most exciting things I heard, as you might expect, Andrews, is the idea that insurers may be asked to disclose their annual average loss, not just within their regulatory returns, but within their wider returns to investors. And at the last meeting of the Sendai Framework Group, a great atlas and map was produced about AAL's annual average loss for countries, formally. It's very exciting. And just a question, is the idea of some of those metrics which have become so important to our industry potentially being applied more broadly? Because people say often to me, we're worried about climate change, but what are we changing from? What is our current risk to both physical as well as the other risks? So for us to understand what the difference between our risk is now as a company or an entity and or a city and what it will be in 2030 or 2050 with the new scenarios. So this idea of using our metrics to give people a guidance on their current risk as then a mechanism for then helping them think about the future. So that's... Can our industry help that wider understanding with our metrics?
Thanks.
I mean,
Please,
we had long discussions, about, suitable metrics that would allow us, to identify a common denominator risk metric, that could be applied across sectors. I think annual aggregate losses are one way to disclose our current weather-related risk exposure as an insurance company. I don't think that it would be that straightforward for many other industries to come up with that figure. I mean, it's all based on our probabilistic models and so on. So yes, I mean, it would be nice to have some common denominator, but I don't think it's feasible for all other industries. But having said that, I mean, the honest answer is we weren't able to agree on one common denominator metric, that we could use across all sectors. And the purpose of this first phase of the disclosures is basically also to see what companies report voluntarily and see whether we can, consolidate and aggregate and identify some aggregating factors, going forward. But it triggered the right discussions, and I think it's the first example of one industry that proposed one first metric, and I hope that others will follow and do something similar. So, kind of a leadership aspirations that we have with that.
Very good. Any other comments?
I guess the other thing I'd add to your point is I think there is a lot to be gleaned from and learned from the reinsurance industry as well as insurers in this space, and that's why I think the task force process was so important, because it involved key industry thought leaders and experts as a part of the bottom-up approach in identifying what the disclosure regime might look like. And I think as a regulator, we're going to be looking very closely at those recommendations and considering them, and I think other regulators will be as well. And I view it as somewhat of a collaborative and iterative process between regulators and industry with regard to how to further refine this. My hope is that all sectors of the economy will take to heart the recommendations of the task force and begin disclosing. And I think we'll see some variation in methodologies and approaches to disclosure, both within and across different sectors of the economy. But I think this is somewhat evolutionary. I think there are A lot of tools that are available, though, that in no small measure are tools that are used by the reinsurance industry, which can be helpful to look to. And there are tools, as Cynthia mentioned as well, that are available to do the stress testing. So I'm very, very hopeful, and I think, from my perspective as a regulator, we're going to do everything we can to encourage disclosure along these lines.
Thank you. I have one question there, and then Yoshi, please.
Scott Gillen with Cincinnati Financial. Cynthia alluded to the interesting issues going on in our country, the United States, and the big elephant in the room is Donald Trump. So many of us in the United States are concerned, disappointed, alarmed that he decided to pull out of the Paris Accords. All of the work you're doing is very forward-looking, promotes insurance sustainability. What is the view of the world as to how that action on his part might impact what you're all doing, which is maybe a couple degrees away from the Paris Accords in general, but it's also very important work?
Thanks, Scott. Thoughts on the panel? Starting with you, Natalie? Give you a bit of time, Commissioner.
I'm not sure if I understood the question.
Maybe, well, okay, maybe Cynthia wants to say. Essentially, sort of, how do you see the decision by the US government to pull away from supporting the Paris Agreement? And what does it mean for your country, your sector, and how you address these issues?
I'm sure that my colleagues Dave and Cynthia will have much more to say, but as far as I know, and there are many states in the United States that are making a pull to face this situation in a different manner, like California and New York and others. And also, I'm sure, I'm aware that Bloomberg is also compromising himself to stay for the United States in the way that the president is not going to stay. Is it?
Yes.
I'm sure.
Yes.
There you go, Dave.
No, that's great.
So,
No,
but I'm sure you're going to explain this much better than me.
I have a lot to say on this subject.
2 minutes.
But yeah, thank you. But I agree with what you said, absolutely. I think the way the question was posed was, what does the world think about Donald Trump? I'll leave it to the world to describe its answer. I can't speak for the world, but I can say that I think Natalie's correct, that there is a wide divergence of views in the United States with regard to whether climate change is real and whether it's man-made. And with apologies to all my friends and colleagues from China, the President of the United States described it as a Chinese hoax, so we kind of know where he stands on it. And there continue to be other important political leaders and appointed leaders in the United States that both deny climate change and deny that the overwhelming weight of scientific evidence that it's largely driven by emissions and man-made actions. The good news is that, as you're probably tired of us repeating, those of us that are from the United States, insurance regulation in the United States is done in a state-based system. And so as a result, there's a great deal of latitude amongst state insurance departments and state insurance regulators to continue to address climate change and climate risk, just as there's a great deal of latitude, as Natalie pointed out, with regard to broader policy and program and actions by state governments and municipalities. So, for example, some of you may have read our governor in California, Jerry Brown, famously declared that if President Trump wants to back away from continuing to have satellites orbit the Earth that will look at what's happening with regard to climate change, we'll send a satellite up from California. So California, from a policy standpoint, and other states as well, are continuing to move forward with regard to policy and programmatic activities to address climate change generally. My role is that of a prudential regulator, a financial regulator. That's how I'm approaching this issue. And as I explained, we at the California Department of Insurance have become persuaded by virtue of what's happening externally in the policy world as well as economically, that these are risks that need to be considered and addressed by insurance companies. And so we'll continue to ask that insurance companies do that, and in partnership with the industry look for ways to better disclose and better address these risks, regardless of what President Trump is doing. I also will just close by saying, I don't think that one president, any president, can stand in the way of the tremendous economic forces that are at play and the tremendous policy forces that are at play internationally with regard to reliance on carbon, markets movement away from carbon, policy directions away from carbon. And although President Trump may be able to affect things at the margins, I really don't think he's going to be able to single-handedly revive the coal industry or change trajectory there, much as he might want to. So while I'm personally very disappointed in his decision, as I think more than half the country is, to pull the United States out of the Paris Agreement. Thankfully, there are many subnational authorities and leaders that are going to continue to work in collaboration with other international leaders, both in the insurance regulatory space and outside, around these issues.
Andres, I mean, obviously Swiss Re operates globally. Sort of policy and political risk is a constant. So how are you approaching this issue? I mean, you've been looking at climate change for decades now. Sort of, are there any particular insights of where you see this sort of issue of political risk coming from the US this year?
To be honest, I'm not that negative about these latest developments. I think when you look back at the policy developments around climate change, you know, going back to the Rio summit, I think we've seen quite many, you know, backlashes and issues, and ultimately it culminated in the Paris Agreement. But everybody knows, I mean, that's not the end of the story. I mean, the discussion, the policy discussion, the international governance issue that we still have around climate change will need to be addressed further. And now the official political opinion in the US has changed in that respect, but I think I can't only imagine that this is just a temporary development, because what I'm very positive about is really the developments I see on the municipality and city level. I see a lot of action there on the ground which go completely in the contrary direction, very positive developments. But also on the technology side, I mean, all the leadership around mobility, a lot around renewable energy, are changing the world already now today, and a lot of that is coming out of the US. And so I see great leadership coming out of the US, which is very, very positive. And also the TCFD was basically born and, you know, invented by American leaders. So my picture is a bit mixed, but I'm rather positive about the developments. And, you know, the market economics, I totally agree with that, are clear. The cost of renewable energy is coming down exponentially. Coal is not competitive economically anymore. So these are facts which cannot be changed politically, I think.
Okay, Cynthia, briefly.
Yeah, just one additional perspective here on the reactions to the US withdrawal from the Paris Agreement from the business and investor communities in the United States. First, there's a very significant group that have joined what's referred to as We Are Still In. And we have, you know, 1,300 major US corporations and states and institutions that are fully committed to moving forward to achieve the goals that the US put forth in the Paris Agreement, the nationally determined contributions. Also, I do want to highlight that in May of this year, ExxonMobil, at their annual general meeting, for the first time ever, a shareholder resolution requiring Exxon to disclose their 2-degree scenario analysis of their own operations passed by a whopping 62%. So BlackRock, State Street, Fidelity, Vanguard, all major ExxonMobil shareholders, they're very serious too about climate risks. So I don't think that Trump's decision, for whatever reasons, are changing the opinions and concerns of the business and investor communities.
Thank you. Yoshi, please.
To some extent relate to that, or very much relate to that issue. So Therefore, disclosure is critically important because it's not politicians who decide, but market should decide. And disclosure is a critical sort of foundation that market right to judgment. So my question, particularly Andreas and Cynthia, so the report of FSB is an extremely good foundation for this recommendation. It's solid. One question is, yesterday it's published, and now it's the stage of implementation. Of course, it's voluntary, but to accelerate or motivate companies, and as you mentioned now, 6 insurance companies, including yours, is now adopt this recommendation. So how do we encourage insurance companies or financial sector, global industry to implement or to do this type of recommendation, use it, So, and one assumption is Cynthia's, institution do some interpretation and do it easy to use for investors. So, for example, your institution or others can make use of this kind of recommendation and much easier for investors to understand. And, so are there any effort or idea to this voluntary recommendation will be much widely implemented around the world?
Okay. I mean, it's a market-led initiative for the market, which was welcomed by the FSB as a development initiated, but also welcomed in the end. I mean, I can imagine, expressing a statement of welcoming these new disclosure standards, by standard setters. I think that would certainly also help to increase the recognition that this standard is here to stay. But you're right. I mean, in terms of translating the standard into actionable, easy to implement measures, there are initiatives already triggered and pursued, for instance, by UNEP-FI. I think they have a task force which looks into translating that for the banking sector. I think the insurance part will follow suit. But I think these developments will evolve and will get started naturally. And a lot of other standards, have also publicly announced that they will adapt their disclosures. So CDP, for instance, Carbon Disclosure Project, has said they will align themselves to the TCFD guidelines. ClimateWise has indicated they want to align themselves. So we see already an alignment movement around, among the other standards that are out there. Some 350 other standards, I have to say. So my hope is that the convergence momentum will accelerate further. And we will certainly make what we can to support that also in this first phase.
Okay. And I think both of you, Natalie and Dave, mentioned the role of supervisors. I mean, how to support and encourage. I mean, in Brazil, Natalie, have you had any first thoughts about how to encourage the sector to adopt the recommendations?
From my experience in Brazil, and I believe that also in many other jurisdictions that really need improvements on the inclusive insurance markets, I believe that the real encouragement to the market to adopt the recommendation is a mandatory requirement. And as I said in my presentation, many insurance companies in Brazil, they are PSI signatories. But it does not mean that they are really doing something in changing their risk assessments to look for this kind of risks. They have a lot of difficulty to really transform the speech into actions, into real actions. I think that kind of framework to try to put it in a more low-level stage and put a kind of developing degrees would help some of these companies. But I think that what it would really make the difference is if us as supervisor put a kind of mandatory requirement.
But you intend to do that in Brazil?
I'm not the superintendent. It's what Dave can do this. He has already done. I'm not. But it's our proposal. We have a group, a project, a group working on this project. That's just me and another colleague. So we are proposing this to the board.
Andrew, you wanted to jump in at this point?
Yes, I have a big wish. Don't make it mandatory, because I think that the standards are not yet, clearly defined. The metrics are not yet clearly defined. The models are not clearly, developed and can be used by each of the companies. If you make it mandatory, then the regulator would have to make that further development in a way, and you would be asked to define certain issues and come up with metrics yourself. And I think I would really keep that as a market-led initiative, give that initiative the time to develop, mature, and identify the key metrics. And when that is established, then you can strengthen maybe the regulation burden. But at this point in time, I think it would be counterproductive, to make it mandatory.
So it's starting to hot up on the panel. We've got 4 minutes left. Dave.
So the California Department of Insurance recommended to the task force that they include amongst their recommendations that the disclosures be mandatory. The task force, for the reasons that Andreas has laid out, declined to incorporate that recommendation. So the task force recommendations are voluntary. I think this is and should be a topic of discussion amongst regulators and with industry, and it's certainly going to be something that Natalie and I are going to ask the Sustainable Insurance Forum to think about. That is, what should our role be as regulators with regard to this task force report? And I think it's certainly something that I would anticipate the IAIS might want to think about also. I suppose that there's a range of places one might land, and a possible midpoint too is to say, look, just to throw this out there for discussion, let's see how well industry responds to initially a voluntary approach, and see what level of take-up there is, what level of comprehensivity with regard to disclosure, what kind of modeling and degree of sophistication is incorporated as a part of the response to the four core components of the recommendations, and then once one sees that, make a decision about whether or to what extent it's necessary for regulators to make it mandatory. You could even pose that affirmatively at the front end to say, our hope is that this will be responded to in an affirmative and positive way. We think it's important. If it turns out that it's not responded to, then we'll have to seriously consider whether we want to incorporate it more directly into our supervisory regime. So that may be a potential place for supervisors to land in concert with industry.
And Cynthia, how are investors approaching this question?
Well, I think it's an interesting paradox in a way, because as we work with many institutional investors, they want to know more about the risks, especially as they're investing in fossil fuels. But they are also not sure how and when and if they should disclose their own risks. And so it is a challenge, and we do try to work that through with them and push them to start to figure this out. But I think, I guess it comes down to, if we have a material risk here, and I think we do, maybe not for every company in every case, but in many cases, then I think it is going to ultimately be the responsibility of the regulatory community to make sure that those techniques and methodologies and practices are implemented, because that's the oversight responsibility of the regulators.
Great. One question there, please. Do you want to come to the mic?
I certainly understand, Mr. Spiegel, the desire to have companies come up with best practices about disclosure. But can you talk about the risk of inconsistency? One of the things regulation provides is a consistent expectation for all issuers. And I worry about the imbalance of voluntary disclosure and how long that might take. I can't repeat that, I'm sorry.
Yeah, I mean, that's not only an issue, inconsistency, I think that's a fact, right? I mean, we have to expect that what gets disclosed will be totally inconsistent, and we have to find ways and common denominators, and, and push that development further. I mean, in the hard work that we've done in the task force over the last 1.5 years, we couldn't agree on key metrics, and that's among experts, on this topic. And if it becomes mandatory, I mean, then the question of companies would be basically to the regulator, what metrics do you want to be disclosed? And then you would have to decide on that, not knowing what the best metric is. So I think giving it little bit more time to see what gets reported. I think the climate transition is also a very long-term project, right? The Paris Agreement is aimed at 2030. The 3 degrees or the 2 degrees impact is expected to, materialize at the end of the century. So, I mean, in terms of regulation and in terms of disclosure requirements, I think we have some time. The pressure is on the carbon-intensive industries to reduce the carbon footprint, and that pressure is already, eminent with the NDCs, with the national reduction targets, I think. But in the insurance sector, I think it's not necessary to make something mandatory that is still ill-defined.
I'm going to have to stop it there. We're 1 minute over. My conclusion is this is an issue that's going to stay. If you need any reading material on your planes back, as Andrea said, there are 3 volumes of the FSB report. And it'd be good to have a survey to see how many people stay awake until they've finished all 3 volumes. But it's a serious matter, and I think we've heard that actually action is already being taken by industry, by investors, and by supervisors. And I'd like you to join with me to thank the panel for their comments.